Hey, it's Pete, and welcome back to the channel. Today's video is a replay of a session that we do every Saturday with our community. If you're finding the current market environment is a little bit challenging for swing trading, stocks and options is what we're going to talk about in this video. Today, you're in the right place because we're going to break down the current trading range in the S&P 500. We're going to talk about why market breadth has actually improved despite what's going on in the global conflict. And we're going to talk about how to narrow down information overload and just get to the differences between strategy, implementation of that strategy, and most importantly, towards the end of the video, we're going to show you a performance diagnostic dashboard, something that we call the performance engine, on how to focus on just the 3 things that matter to fix your trading. So buckle up, and if you want to attend these sessions, click that link below the video. We'd love to have you come and join us. Take care. Hey, John, good morning.
Good morning, Pete. Happy Saturday, everybody.
Happy Saturday, everybody. So obviously we have some, as John, using your immortal words, we have an unknown unknown.
Yes.
Hitting the market overnight. The U.S. and Israel attacking Iran. Iran choosing war over negotiations after, I think we left Friday morning with the news being that the talks were intense but not going anywhere.
Yeah. So I kind of called this yesterday. I told a lot of people that I was just kind of dealing with, here, that I thought it was going to happen over the weekend, because it just seems like, well, first of all, weekend is an ideal time to do it because it obviously have a couple of days for the market to digest what happened. Also, they had closed door meetings. Trump's schedule all of a sudden became very hush hush. So he had a lot of closed door meetings, obviously, with different people. He did brief Congress. So that was a couple days ago. I think Chuck Schumer gave a kind of a negative statement, obviously the polarization and the back and forth. But he did alert Congress about what's going on. So that was a major shift. And, like what he did with Venezuela, for instance. So this is a lot more serious. It's a lot more, it's going to be a lot more sustained, I would imagine. And it looks like, from what I've seen in the initial news, it's going to be a decapitation. He's trying to it's going to be not just nuclear annihilation as far as like getting rid of the facilities and stuff like that, but it seems like he wants to do a decapitation as well, which wasn't in the cards just a couple of weeks ago. He was happy just getting rid of the nuclear. But now he's like, hey, if I'm in here anyway, it's going to be decapitation. So that's...
So what do you mean by decapitation?
Getting rid of the regime. Regime change. Yeah. So it seems that's what the initial targets were, actually. There's news reports now on Bloomberg. I'm looking at it now that they didn't get him. So there was uncertainty whether they got him or not, the Ayatollah, but it looks like they didn't get him. But we'll see. We'll see how things kind of come out. But this could go on. This could go on for a couple of weeks or a couple of months or even longer. And, there's a lot of uncertainty now. There was before, but now with this situation, the bottom line is, and we talked about this before the call started, regional wars usually get initial volatility, uncertainty, unknown unknowns, like we talked about. But then over the course of a couple of days or a couple of weeks, it calms down a little, assuming, and here's the big assumption, that it stays regional. So if it stays regional, then the market will largely shrug this off. I know that sounds crazy, but yeah, maybe with the exception of oil. There's a huge spread, by the way, right now between crude and Brent crude. The Brent crude is, I believe, the more Middle Eastern oil, and the WTI, West Texas, is here, and West Texas is $67. Brent is $73. It's a big difference. So that goes to show you what people are thinking right now. If WTI starts to track Brent a little more, that'll indicate that this is going to be a more sustained campaign, like a longer campaign. That spread, that wide spread between the two, actually indicates right now that the oil markets are pricing in a short conflict.
Oh, that's interesting.
Yeah.
So Thomas obviously, asked the obvious question: do you think defense stocks like Lockheed Martin, Cummins, and Kratos will be in play next week with this news?
Well, it's kind of already priced in. You know what I mean? I think the insiders by now and everything, I think they were pricing in some sort of conflict at this point. You can see just by the stock chart. You know what I mean?
$16.
So I think all the logical trades are already priced in. You know what I mean? I think the ones, the ones you have to look for are the ones that are maybe a little more illogical, or where there's a little more asymmetric upside opportunity. And I think, believe it or not, I know this is going to sound crazy, but Magnificent Seven stocks, names that have now are now getting, beat up a little bit, they eventually will start to look interesting. I don't like counter trend trading necessarily, but I think at some point it gets so bad it gets good, and those will be some good opportunities in the days and weeks to come. But they have a long way to fall, if the market does get unhinged.
Very tough to bet against Microsoft and those kind of companies, even though how far they've come down. Microsoft's actually in bear market territory right now from moving average perspective and how far it pulled back off of the highs. But no matter how bearish it looks, I mean, it's down 30% from the highs. It's just a tough company to short, even if it's going down.
Yeah, you know what it is? They have such a cash hoard. So Microsoft, NVIDIA, and I believe the third one, I believe, is Amazon. I have a chart somewhere. They have a lot of cash. And they're the ones I think we have to start, forgetting about the word Magnificent Seven. I think we have to start looking at them individually now that the party's over, so to speak. You know what I mean?
It went from FANG to Magnificent Seven.
Yeah. So I think we have to kind of start dislocating them a little bit. Like Meta has like very little cash. So they are more apt to take on debt, and they're more apt to do stuff like that. NVIDIA, Apple, it was Apple actually. So NVIDIA, Apple, Microsoft, those three have the most cash, and then Amazon's a little bit behind them. So they could withstand AI investment and infrastructure and CapEx spending a lot more than something like Meta. And you could see by the size of Meta, the market cap is shrinking compared to the others. So it's starting, the chickens are kind of coming home to roost a little bit.
Meta's starting to talk about 100% of their free cash flow going into AI CapEx. That's a scary number.
It is a scary number, especially since they don't have as much cash as the other guys that we mentioned.
Especially Google. AI is like a side project for Google.
Yeah. So it's how each company handles the AI situation, how and who ends up becoming the victor. Now, to me, whenever there's an unknown, like what's AI going to do in the next 10 years, nobody knows, right? You could have an idea. The best, I think, pony or horse to bet on is the one who's got the most money. You know what I mean? And that's NVIDIA and Microsoft and Apple. So that's just because they have enough, they have a better balance sheet. I don't like to get into fundamentals on a trading call, but it kind of bleeds in a little bit. You know what I mean? Yeah. When you're trying to think about, what the future might hold with some of these. But I think the biggest theme on this is we got to maybe stop thinking about Magnificent Seven and start really looking at them individually. Now that kind of the easy money is over, as far as trying to pick these.
A lot of the easy money was based on expectations of what it could be. And now those expectations are turning the software industry upside down. And it's pretty much the only thing I've been hearing or reading about over the last month or so with, is there a bottom? Where is the bottom? Is it time to start bottom picking these stocks? And really nobody knows the answer.
Yeah, absolutely. One thing that's interesting is volatility. I think, the VIX was up obviously on Monday. It's up to 20. But I think 20 is not enough. I think that even if the war remains regional, I think that if you're an institution and you're a mutual fund, man, always goes back to the institutions, right? I always talk about institutions. If you're an institution and you're a money manager and you're managing billions of dollars and now you have this new situation, right? What do you do on Monday morning? You know what I mean? What would your number one thing be? What would you do? And to me, I would buy protection because I don't know how crazy this thing is going to get. I don't know how long it's going to last. I don't know if it's going to spread. So that's enough risk for me, especially if I'm a fiduciary managing billions of dollars. I would start to buy insurance. So I think the VIX,
in the form of puts.
yeah, yeah, some sort of protection. Yeah, some sort of, yeah, that would be the easiest way to do it. So I do think that the VIX would be a good trade this week to look at as far as holding a little bit of VIX going into the next couple of weeks. Now, if it remains regional and there's no surprises, that could be a dead trade. It could just sit there at 20 for a long time. You know what I mean? But I think that would be a logical thing for institutions to do. And if institutions are doing it, I'm going to do it. So I'm going to look at VIX or some sort of protection going into next week, some sort of hedging mechanism, whether it be puts like you mentioned or VIX itself.
So, John, we mentioned just prior to starting the call, we started talking about the SPY continuing to be in this box, really back and forth pretty much every other day.
Yep.
And how to take advantage of the fact that it's an obvious trading range. Now, on your side of things, on client management and whatnot, without getting into any specifics, obviously, how are you approaching the sideways market where clients are still expecting performance?
It's very challenging because when you have a sideways market, obviously people can't pay their bills in sideways, right? So they're always worried about cash flow and income and that stuff like that. And when you're managing other people's money, a lot of older clients, especially, or people, even people in their 50s and 40s, people that are still working, they want cash flow. They want to have like some sort of monthly reliable income. I think everybody does. You know what I mean? Older people probably rely on it more because they're more on a fixed income. But yeah, so when markets are going sideways, you can't really do much with capital appreciation. But what you can do is use the options market, right? So one of the strategies I like to use in a sideways market is, I definitely like to implement the wheel strategy. It doesn't necessarily yield a tremendous amount of money, but what you can do is sell out of the money put options that, on ETFs and on sectors and on indexes that you're willing to own, right? So if let's say you have a retirement fund that you're managing yourself. That's a classic example. I always use my brother as an example because now he actively manages his IRA. So my brother's like 61. He's going to retire in a couple of years. He still works full time. He has a 401k with his job. He has all that, right? But from previous employers, like he's had maybe, 5 or 6 jobs his whole life, right? So I told him he had when he first opened up to me about his financial situation, I said, listen, why the hell do you have 20 million different 401ks floating around that you have no control over, right? Let's consolidate. So he has an existing 401k with his employer. You don't touch that. You contribute. That's fine. But what you do is you take your 401k money from all those old employers that are lying around and you consolidate. You put that into a self-directed IRA. And that is where this comes in. So what I had my brother do is a simple wheel strategy where you're selling puts on names that you're comfortable owning. That could be stocks, that could be indexes, that could be sector ETFs, it could be anything.
That's a very important point, by the way, just so everybody just doesn't start thinking about the income part of it. You actually would like to own them at that price.
Well, you have to have some sort of strategy. You know what I mean? So yeah, and if you don't want to own it, you have to be willing to sell calls immediately against the position that you get assigned, right? So you could do that as well. And if you're willing to take a loss on that, that's fine. You know what I mean? But that you have to have some sort of strategy of ownership, whether you are comfortable owning a name or whether you're going to set up a situation where you get called away immediately by selling calls. Now if the thing tanks, you might have to sell an underwater call where your initial strike price for the put was underwater and you took a loss on the position. You could do that, but most people don't do that. I think if you're willing to own something and willing to hold something, then you can write calls against it for income and still have the position. You know what I mean? So that's what I kind of set my brother up to do. So he was doing, comfortable stocks that he's comfortable owning, household names like Microsoft and so on and so forth. But mostly ETFs. He did a lot of SPY, a lot of QQQs, a lot of stuff like that. And he just keeps doing it. He'll sell puts, get assigned, wait a couple months for it to bounce back and then get called away. And then he'll have cash and he'll repeat the process. So sell puts, get assigned, sell calls once you're assigned, get called away, end up in cash. And if you do that in a sideways market, you're going to collect income, and you'll make money more so than if you're just sitting in names and not collecting any kind of income. The downside to that is a rally. If you get a massive rally, you're going to get called away at unfavorable prices, because what will happen is you'll get called away and the stock will run away from you, right? And you're going to end up in cash just at the worst possible time when markets are rallying. So it tends to lag in major rallies, but it tends to do really well any other time. So in bear markets, you're making money. In sideways markets, you're making money. Even in slightly up markets, you're making money, as long as it doesn't hit your call option, right? So 3 out of the 4 outcomes, you're making a decent return. The worst case scenario is you don't make as much money as you would have if there's a major rally. So to me, that's a pretty good probability set. You know what I mean? So that's what I try to tell him. I'm like, make money in all weather conditions. You know what I mean? And that's really because he was so obsessed with direction. He was so obsessed with timing the market and direct. I'm like, just forget about trying to time or predict. Just follow that process. Has certain guidelines and risk management rules in place, obviously, but that's a very viable strategy for people.
Good. Good question here by Nicole. How do you hedge with the VIX?
Well, there's a couple ways to do it, Nicole. You could just buy VIX, which is a European option, right? It's basically an option on the futures, the VIX futures. And you could size it based on the size of your portfolio. But I would recommend picking a further away maturity than 1 month. I would go out a couple extra months, because you never really know when the VIX is going to spike. The problem with going further out, though, is they do get expensive, because obviously the uncertainty. So you want to own VIX when volatility is really low, but at the same time, it's like a slow bleed. You know what I mean? So really, you're buying insurance. So you can't expect, if there's 2 ways to trade VIX. Are you speculating on a move, or are you protecting? That's the question. So Nicole's question is, how do you hedge? Well, you can just buy VIX when it's really low and cheap, like it was a couple of weeks ago, and just hold it for 6 months or so. And if there is a spike, you just take that profit and offset it against the portfolio losses that you have. You know what I mean? Another way to do it is you can just go ahead and buy puts on SPY or QQQ. That's not a VIX hedge, that's an actual market hedge. So those are the 2 primary ways I like to hedge my portfolio.
So I know we talked about this a little bit last weekend, John. I don't know if you want to just do a refresher here. I know last weekend we spent some time on hedging versus portfolios being short.
Time to expiration. These are all good questions. So it depends whether I'm hedging an event or whether I'm hedging to hedge, right? So I'm assuming, let's assume for a second you just want to, let's say your portfolio is up 20% and you just want to protect yourself, right? There's a couple of different ways to do it. The cheap way to do it is so the way to protect cheaply is to buy a collar or to buy an out of the money put, right? So you're basically hoping the put goes to zero. You're hoping that you don't need this thing, right? So you're buying cheap car insurance basically, right? So let's say you have a significant portfolio, you have your investments or you have your option strategies. Let's say you have a whole bunch of stuff going on the long side, whether it be investments or whether it be, a trading portfolio. You could buy out of the money puts. So out of the money meaning, so you mentioned Delta. Delta could be somewhere 20 or 30, pretty out of the money. Now those are relatively cheap, especially in a low volatility environment. So you can load up on those, and then you can do something called a collar if you want to. So in a sideways market like we're in, I prefer to do collars, because if you're expecting kind of a range bound market without a breakout to the upside, I think a breakout to the upside, a significant breakout to the upside, is probably a very low probability outcome right now, I would say. I think we're either going to stay in this range, maybe we'll drift a little higher, we'll drift a little lower, who knows? But I think there's a low probability of a massive breakout to the upside. That's my guess, unless they discover aliens or something, who knows? But for the most part, I think we're kind of where we are, right? So to answer Nicole's question, you can buy out of the money puts, let's say with a 20 to 30 delta, super cheap. You can go out, now you can do this monthly, but it's going to cost a little more money. You could, so you know, if you're hedging like a larger portfolio, I would do it monthly. You go out a month, do a 20 or 30 delta put option on SPY, let's say. And then what you do is you sell calls against your position. So let's say if you own SPY, you would sell an out of the money call, and that call that you sell will pay for the put that you bought. That's called a collar. So now you're long a put and you're short a call, and you own the underlying. That's a collar. Now, the zero cost collar is where it pays 100%. Like you find a call option that is the same price as the put option that you paid for. Now, when you do that, it's usually a pretty tight situation, right? And if you do that, then in a sideways market, that might work. Ideally, you don't want to get called away because you own the underlying. It's not really your intent. Your intent is to protect. So my recommendation would then be to just buy the put options, or further away enough call options where you don't think it's going to hit anytime soon. So that's an effective way to hedge. You could do that on a monthly basis, or you could go out further, but the further out you go, the more unpredictable it gets. The more hard it is to find targets and stuff like that. So you could roll it every month if it's relatively low cost.
Thomas is asking about options books. Boy, books have taken on a different.
I haven't read a good options book
online.
Yeah. I'd have to get back to you on that because I haven't read a good one in a while. I've read some of the more standard ones, but I think that I really like I know the folks over at Maverick Trading. They're a prop firm. They have one book that kind of goes over a little bit of the process of like top down and stuff like that, and different strategies. But everybody really has their own strategy. I think if you look for a book on options, I guess the question is, are you looking for strategy, or are you looking for just what are options? Like, how do options work? Because there's lots of great books on how do options work, but there aren't that many good ones on strategy. Because what they do is they just give you one or two strategies. They don't give you the whole enchilada. The whole idea of options is to use which strategy works at which time and which situation. And most books don't cover that, unfortunately. I would love to write a book on it myself, but it would probably take a really long time, and it would be like 1,200 pages.
I actually, somebody had recommended this options book to me a while back. Let me actually just pull this up here. It's actually sitting on my shelf right now, but this is one that I have found pretty good. The Bible of Option Strategies. It's again, this is kind of in the context of what you were saying, John. It's more about strategies than just what is an option. It's actually how to put the different types of strategies together.
Yeah. Now that book might give you like all the different strategies that exist in options land, but it might not tell you when to use them. And that's the problem. You know what I mean? I think that, understanding how all the moving parts work is really important. Plus, your own risk tolerance too has a lot to do with it. So sometimes they can't answer that question for you. Like some people who are super aggressive, they just buy puts and calls. It doesn't matter what volatility is. They don't care. They just buy puts and calls. To me, I think that's suicide.
It's so funny you say that, if you don't mind me. Every professional options trader that I know says exactly what you just said, that just buying straight puts and calls as a way to trade options and that being the only thing you do is the most dangerous thing to do. And every retail trader, that's mostly what they do.
Well, it's funny, and I don't want to like completely poo-poo the idea of buying puts and calls, because
situations for everything. Sure.
Some of my most profitable trades have been straight calls and straight puts, but they're special situations like GameStop. You know what I mean? Like special situations. But yeah, I think understanding how dangerous time decay is for options traders, that the whole idea of time decay is completely ignored by rookie traders who just buy straight calls and puts, because they don't even think in terms of what their time frame is. How long do they want to stay in the trade? Those vertical spreads, even though you are capping your target based on the short leg, when you do a vertical spread, whether it be a put spread or a call spread, you are saving 20 to 30% of the cost of your trade, and you're allowing yourself to sit through volatility, and you're allowing yourself to deal with time decay. You're knocking out all those problems just by putting on the second leg to your trade. Yes, it is a little more complicated. It takes a little bit more time to master. But once you do that and you do it effectively, that's like 80 to 90% of what I do.
I think it's interesting that, again, a big generalization about retail traders, but I think professional traders are more focused on probability of winning, and retail traders are very focused on the magnitude of winning.
Yeah, I think you have to focus on not losing. That's what you have to focus on, risk management. So vertical spreads allow you to do that significantly, even in a low volatility environment. To have to have some sort of cap on something sounds like counterintuitive when you're trading, but most stocks have a certain rhythm. Most stocks have an ATR, right? That's reliable, right? So the stock tends to move at a certain pace, whether it be up or down, and you have to take that into consideration. Now, if a stock completely blows through your expectations, let's say you buy a vertical call spread at 100 and your target is 110, and you wake up in the morning and it's at 120, right? And it's because there's a news event, right? Or there's some event happened that you did not plan on that caused your trade to outperform. That's a brand new situation. Your edge is now different, right? So what do? You can just buy another call option. That's when you buy a call option, right? Because now maybe the new target's 140. Maybe something happened, right, that causes the stock to behave in a way that you didn't expect to the upside. And then just buy another call option. Now, that to me is aggressive, and that's when you would buy a call option. So there are times when it's appropriate, because now you have a profitable trade and you're essentially double downing. You're essentially saying, okay, the profit that I made, unexpected thing happened. This thing has a much different target now than I thought it had. I thought it was worth 120. Now it's worth 140. For whatever reason, I'm going to go ahead and buy a call option. That's a new trade, essentially. You know what I mean? So that's kind of how that works. But yeah, so with different option strategies, there's iron condors, there's credit trades, there's credit spreads, there's butterflies, the targeted butterflies. There's all kinds. You just got to know when to use them, and how to use them. And unfortunately, some of the books are really good at explaining the mechanics, but they don't tell you when to use them.
It's very interesting. We spend a lot of time talking about the difference between chart reading and trading. And the trading part of it is actually the decision-making process, not just the technical setup of what you're looking at.
Yeah, like a lot of people say, well, what's the difference between a butterfly and a targeted butterfly? They're a huge difference. One, it's the same trade. Like, it's a three-leg strategy. They're both three-leg strategies. But a targeted butterfly, you're picking a price where you think it's going to go to. That's an earnings play. That's a situation where you're expecting something to happen. A regular butterfly is you're expecting nothing to happen. You're expecting it to stay exactly where it is. So it's the same setup, right? It's the same three-leg strategy, but it's for completely different reasons. That's a classic example of like when to use something. You know what I mean? So that's where the education comes in.
John's talking about hoping to try my first options day trade next week.
Excellent. Well,
I was going to say, just as an aside from that, John and everybody else, we're going to be sending an email out next week. I spent the better part of the last 2 months negotiating with a prop firm for only day trading. I want to be clear about this, for day trading stocks and options. It's a company that is pretty well established out there, but I negotiated for our community to get a better rate on joining and becoming one of their challenges, so to speak.
Oh, nice.
For stocks and for options. And the interesting part about it is they actually own a trading firm. So it's one of the traditional new models out there where you have to earn, your way through the challenge. But the interesting thing is, because they actually have a very well-funded fund behind it, they're actually using the challenge to find traders to put into the fund. So everybody be looking for an email for that from me, definitely within a week. definitely within a week. And it's only day trading. I want to be clear about that, but it's stocks and options, and they're looking for people to perform within the challenge to eventually put them or to move them up into the fund. So I'm pretty excited. We've been negotiating back and forth for a while. And I wanted to make sure it was something that was comfortable introducing our community to. And it's gotten to the point now where I'm going to do a presentation of what the rules and the guidelines are and everything like that for profitability. And I think our trading strategy fits in perfectly with the rules of their program, because they're not really looking for somebody who's going to make most of their money on one big trade. They're really more looking for exactly what I look for at my firm, which was, can you manage risk? Like, can you manage the downside? And if you can, you'll end up having access to more capital because you've proven that you could manage a trade. So they're really looking for consistency more than just one big hit. So look for an email coming up no later than next week. That I can promise you. I just want to put a presentation together that's very detailed for like how you actually get paid, what the drawdown numbers are. And it's going to be interesting for a lot of people, probably most people, quite frankly, who've never traded for a prop firm, that you will now have a risk manager for that particular account, which is actually good, because sometimes you can go on tilt and
that's cool.
On your own account, you don't have somebody to tap you on the shoulder and say, go home, for lack of a better way of putting it.
Well, with prop firms, there's always someone tapping you on the shoulder.
Yeah, exactly. So we're going to send that out next week. No later than next week, actually. Let's see. Hey, Ed, good morning. Most stocks that are optionable are not worth trading options on due to the bid-ask spread. My favorite options trade is the diagonal. What are your thoughts on that, John?
Well, I think it depends on your time frame. I think, there are very large spreads sometimes between bids and offers. He's absolutely right. But if you're going out several weeks or several months, if it's a swing trade, I'm willing to deal with a little bit of illiquidity, because the longer term trend of the individual stock might be more favorable. If I'm only going to do something if I have a very short time frame, like a week or even a couple of days, then he's absolutely right. Yeah, you have to be a lot more conscious of open interest and volume and liquidity. Diagonals are great, by the way, because as a general rule, especially high IV ones too, because you kind of need them. You kind of need higher implied volatility with diagonals, because you're going long. The one you're going long, your call option, the one that you're actually buying for appreciation, let's say. That you might buy a couple months out. And then what you're doing is you're essentially selling a shorter one that's maybe out just a week or two. So ideally, in a high vol environment, that's helpful because you get a quick premium. It helps lower the cost of your trade, and then it allows for a breakout. So a diagonal is great when you're expecting a sideways market with a breakout, which is not what I'm expecting for this market. But if you were, let's say we were in early bull market right now, and let's say we've been basing for 3 months and we're bored as hell, and we just think the market's waiting for a catalyst to jump back to the upside. Diagonal spreads work really well in that type of environment.
So ironically, we had taken a look at the difference. We spent probably all of 2025 talking about Mag 7 and probably even 2024 more, carrying the entire market. And we've seen the picture of the SPY going sideways for multiple months, and the equal weighted is making new highs and trending. So the market breadth is actually still pretty strong right now.
It's 50-50 still. You know what I mean? So it's 46% above the 50-day. So, that to me, that's still a fairly bullish market. You know what I mean? Yeah. A market that's not falling apart at all. A market that's maybe just buying the boring stuff right now, unfortunately.
This is actually a good question. I have a very specific answer here. Lately, swing trades seem to be harder to follow through. Should we navigate towards day trading instead? Absolutely, positively not. No, absolutely not. And I want to say this from a very experienced perspective. What will end up happening is you'll drop time frames, and you'll be spending a lot of your focus on those short time frames. And then when the market picks a direction, you're going to still be managing trades on those short time frames. You're going to be cutting everything short. I do not recommend doing that.
I'm trying to understand the question. So because we're sideways, we should lower our time frame and
You're
trade.
trying to find ideas on lower time frames that might not necessarily be on higher time frames,
So
but you don't realize how your recency bias starts to kick in, and then when the market picks a direction, you're still gonna be like, oh, it moved in my favor, I have to get out, which you did on like a much shorter time frame. And I can't express it only. I don't recommend doing that if you're normally a swing trader.
I understand the logic behind it, but I agree. Like, because if you're in a range-bound market, if you drop it to a lower time frame, you could trade the range. But then you're kind of becoming like tunnel vision a little bit. You're kind of, I would say 50% of this, maybe not 50%, maybe 40% of the sectors out there are pretty bullish. So there are stuff to do to the upside, whether it be in options or stocks. There's utilities. I know that sounds really sexy, but utilities, consumer defensive.
William just mentioned XLV.
Industrials. He mentioned what happened with XLV. So XLV was kind of struggling a little bit. It had a really good day, recently. I think, there's a lot of talk about the prescription drugs and stuff like that. The danger of profits being hit by Trump's idea of making prescription drugs a little bit cheaper. So I think there was a little concern there. But it looks like, XLU or XLV? I forgot which one he mentioned.
Well, he said XLV. I put up XLU because you mentioned utilities. We've been talking about that for a couple of weeks now on Saturdays.
Yeah, utilities are on fire. So that's the thing. But XLV has been struggling. It was up a little bit on Friday. I think it was more of like just kind of a little bit of a dead cat bounce because it's been pretty range bound, struggling a little bit.
The one company over there is not having a good day is Nova or Nordisk. They have bad news like pretty much every week now.
Yeah.
But the drug to tie that in a little bit, though, all the drug manufacturers are in really, really strong bullish moves right now. The major ones, Johnson & Johnson, probably at the top of the list now for a while. So there are opportunities, but that's kind of why, John, you say you're 60-20-20. We have the power pyramid, basically the same thing. Just got to do a little bit extra work and see what industry groups have attention right now. I don't disagree. It's been harder to get followed through, but there are trades out there if you dig them out.
Yeah, I think so. And I think there's enough of a trend in these. It's not like they're just up for a day or two. Sometimes you get a rotation that lasts like 1 or 2 days where, it's just kind of hedge funds repositioning and, you get like algorithms following that. And it's like a 2-day thing. There's been real trend now into these different sectors, like into these lower value or the whatever non-growth related
consumer discretionary has been strong. I think it's been popping up in my industry group analysis probably the last 2 weeks is household products like Clorox and Philip Morris. They've been trending. John Campbell Smith's on the call right now. It's funny you just mentioned something that's been a short-term trade. He had this trade in GLW the other day, 4 days, $30, boom, take it and go buy yourself a beer.
Yeah. I mean, there are lots of really, really, not too sexy names that are really outperforming. That's one of them. And then you have, look at Hershey's chocolate bars, HSY, another one. Stock looks like NVIDIA did 2 years ago. It's just that's where the money's going.
So we got a little bit of a testimonial here for you, John. Thank you, Ganny. I believe the best way to learn options is to sign up for John's options trading course. That is 100%. And ask John questions. Get on his coaching calls on Tuesdays.
Thanks for the plug, man. That was free. I didn't pay him to say that.
Gave him $10 under the table.
Yeah, but I think what I really try to do in my coaching and then even in today's session is just options are not as complicated as people think. Because there are so many choices, I think people feel overwhelmed. I really try to break it down to a couple of simple strategies that work at certain times. And that's what you do. If you want to add variations to it, express it different ways as you practice and get better at it, you can go ahead and do that. But for the most part, It's like I like to compare it to like when you go and you have to, like, let's say, do some work around the house and you have to buy a drill at Home Depot, right? When you go to Home Depot and you buy a drill, how many drill bits come with the drill? You know, when you buy that drill, there's a little metal drill, like probably hundreds of little pieces, right? How many do you really use?
Maybe two.
You use basically two, right? It's options are kind of like that. There's all these books and strategies and things to do and stuff like that. And yeah, there'll be some that you're better at and some that you'll feel more comfortable with. That'll take a little time to practice. But for the most part, you're only going to have like one or two go-to strategies. The rest of them you're going to use once in a while. That's the best way I could describe it.
Guy's got a question about hedging.
So when hedging, starting with whatever your key level is, do you hedge all at once to achieve the protection you're looking to get, or do you build into hedges similar to a stock? That's a very good question, and that really depends on your account size and what you're trying to hedge. So if you are, I would say most people, a retail trading account should be relatively small, especially if you're trading just options. And I always say you should separate your investing world from your trading world, right? So like if you have an investment account that you want to hedge, I would say the latter. You might want to leg into a hedge because it might be a large sized account. You know what I mean? If you're talking about a 7-figure retirement account, yes, you should probably do it in pieces. If the market pulls back 5%, put on a little bit of a hedge. If it starts getting worse, you could add to it, and so on and so forth. But if you're trading, let's say a $25,000, $50,000 trading account, and you're looking to hedge something like that, you could do it all at once. You know what I mean? You could put it on all at once where if the market dynamics, and this goes back to grading the market, if the market drops from an A+ down to a C- in 1 week because all hell breaks loose, ideally you want to throw on a hedge immediately, as fast as possible. So the short answer is it depends, and really it depends on what you're protecting and how big it is. If it's more of an investment you're trying to protect, then you would leg into it and do it in stages. But if you're doing it to protect a smaller trading portfolio where you just don't want to get caught off sides, and you feel like you're too bullish and you should be a little bearish and you just want to add a little bearish exposure, then you could do it all at once.
Let's see what we got here. Ed's asking about the market reaction to Iran. Ed, we spoke about that on probably the first 10 minutes of the call, so maybe click the replay and you'll catch our talk on that. Yeah,
as a general rule, regional conflicts are largely, initially you might see some volatility, but it'll largely be ignored as long as it stays regional. If this remains just a bombing campaign where other groups or nations don't get involved, I would imagine the market will just keep doing what it's doing, with the exception of maybe oil. There might be some gyrations in oil. One thing I would keep on your radar is what I mentioned earlier. Keep an eye on crude WTI versus crude Brent. If the spread starts to narrow, that's implying that this is going to be a longer event than we thought. Why the spread narrowing implies that? What is this? Well, right now you can buy cheap oil in Texas, right, versus the Middle East. As the supply gets kind of sucked up, and once there's more pressure on the producers in the Middle East, we are a global world, so eventually those spreads will compress. You know what I mean? But what I mean by compress is they'll go up, but the difference between the two will be lower. You know what I mean? That's what I'm trying to say. So right now, there's a disconnect between the two because there's an immediate problem in the Middle East, short term, but Texas is doing what Texas does, right? So it's not a problem, but if that continues, that'll definitely compress. Raul is asking a question. John, you might not know what the trade is. The weekly anchor trade is basically we're buying on Monday. We're looking for a bullish energy candlestick on Monday in a stock that has a trend, and we're looking for a green candle, and we're basically risking between the close and the opening price. So that's kind of the trade set in stone, and it's designed to exit on Friday. So it's kind of a much shorter term weekly type of an idea, not necessarily looking. I mean, we do have protocols in place to hold longer, but this is actually a good question. Is this the right kind of market condition to be looking for those kinds of ideas? And I'm going to say
Probably, and actually, John, you just gave us a good stock to talk about. That this is actually a weekly anchor trade in Hershey. Here's Monday's candle, and you can see what happened over the week, and book the trade, and you move on, and you go to the next one. Now, if you want, you can obviously hold it over the weekend and whatnot, but that's a perfect example right there, and kind of like a boring stock that meets the criteria on Monday afternoon, and then looking to just hold it through the week and not necessarily turn it into a much longer term trade.
Yeah, I think you could take it. Well, I think you might have missed the boat, but take a look at Costco's move on Friday. You had a nice basing for a while, and you had big follow through on Friday. So that's another one where these consumer defensive names, are really.
They come back in Costco after getting beat up. Look at that.
Yeah, so it's had a really nice run, and I think it's got some room still, especially if these consumer defensives continue to gain popularity.
So I actually, just as an aside, I actually print this out every night for the day trading community, because I'm basically printing it out for them to do some analysis on whether or not they're in the right stocks for a particular week. And this is changed from Monday's open in a very specific list that we have. And it's designed to say these stocks were the strongest this week from Monday's opening price for you as a day trader. And it's one that I post after hours every night. And it's designed for the day trading community to compare what they're trading to what moved the most this week, and start to really develop their focus a little bit on, if I'm day trading, I'm more concerned with what's going on right now than where I think the thing's going to be in a month from now. So for everybody on the day trading side of things, make sure you take advantage of this every night.
Awesome.
Fancy graphics there. Let's see, Guy, having been with John on the option side for years, which thank you for that. I agree 100% with Ganny's comment. John provides insight on many option strategies, which I would not have considered otherwise well worth it. I completely agree.
Thank you, Guy. Again, didn't pay him either, I promise. Thank you, Guy.
I think, John, one thing that, information's not the problem anymore.
No.
Like, they like talking about buying a book and whatnot, getting the information to point you in a direction is table stakes at this point. It's really learning from somebody with experience who could walk you through the nuances as market conditions change. Because I on my side, I've been using the same example for 25 years, which is sometimes you're on the road and it's stop and go traffic. Sometimes you're on the road and it's wide open, but it's making that decision in the moment to understand what part of the car to use to keep you safe and get you where you want to be. That's the nuance of trading, where every condition is not the same. And we spend a lot of time here on Saturdays talking, is your edge still there? How strong is your edge? That's the part of being on our coaching community that matters. Not, is this what are you calling this candle? That's not what we're here for. We're here to actually help you understand how to analyze the current conditions and what that means for the actions that are most appropriate at that moment. Yeah,
how to apply everything you learn is the most important thing. What I love about Guy is he'll give me what he's doing, and then I'll say, well, if this was my trade, here's what I would do. And sometimes they're the same, and sometimes I give him like a little bit of, like he said, a little bit of insight into something a little bit different. And it really depends. When you look at a painting in a museum, you're going to have a different view on it than the person next to you. You know what I mean? So I might be more bullish than someone. I might be more bearish than someone. So there's always little nuances, but I'll always explain why. You know what I mean? Like if you give me a trade and you say, hey, take a look at this, and I say, hey, I like the idea, but here's how I would do it. It's just because maybe I have a different target than you. Maybe I have a different time frame than you. Maybe like you said, I'm looking at the market a little bit differently and saying, well, I think because the market is only giving me a B plus or a B minus, I'm only going to do this instead of this. So that's the only, but those nuances add up over time. You know what I mean? If you think in terms of cost and in terms of like how much a trade might cost, those nuances matter over the course of 1,000 trades, because you're taking it to the next level. You're saying, okay, well, I'm bullish on an idea, but here's how I'm going to express it. And that little nuance is very important.
John brings up a good point here too about going through the courses and stopping and restarting and that kind of stuff. That's the part I think that a lot of people take for granted, and that's really good that he's bringing this up, because you don't learn something the first time you're introduced to it. You're gaining awareness of the topic, but to really master the topic, for lack of a better way, you need your repetitions. And then the fact that you can have the repetitions to go through the course, go trade, and come back and ask coaching questions in the context of what just happened to us. I didn't have anything like this when I traded. When I first started trading, there's your keyboard. Go trade 1,000 shares. That was it for the first 5 years. There was no coaching.
Yeah, coaching, it was a school of hard knocks, basically.
Yeah.
And yeah, unfortunately, I had to blow up a few accounts before I figured out what I was doing wrong. You know what I mean? And that's just the way it goes.
Yeah.
When you were younger, back in the old days. So there's so many good risk management tools now. I mean, especially technology within the brokerage platforms, all the different stop orders you can leave, and just, managing risk is really what keeps you from blowing up your account. And making sure that you don't oversize, making sure that when you have a position, you know when to step on the gas and when not to. It's really, really important.
Let's see, KG Oil. I like that name. We hedge our oil production. We use collars on the long term. We use options on the short term as to daily and weekly swings. Very profitable in addition to selling the oil at the wellhead. So you're actually an oil guy. That's awesome.
That's
How about
cool.
that for context?
See, collars in use. So collars are done at long term. So I guess maybe that's future. Maybe collars in the futures market. I don't know if that's what he means, because that makes more sense. Because then you're not paying for the roll risk and the because you have contango. So you're paying money every time you do a roll, right? But in the options market, it's relatively cheap because you're paying for your collar. If you do it that way. And protective puts in a low volatility environment, even if you just do protective puts without a collar, they could be relatively cheap. But over time, it does affect your performance. You have to kind of decide what time frame you want to use.
Don is asking about the inverse symbols for the ETFs. They actually have them in FinViz, believe it or not. If you click into FinViz and go to ETFs over here,
there's the leveraged ones and the non-leveraged ones.
Yeah, these guys right here is the list. I think most people use the NASDAQ one, the SQQQ, and the SDS for the S&P. I think those are the most common ones. And then obviously the QID in there as well. But I think SQQQ and SDS are probably the two most common ones that I've seen people use.
And there's TQQQ, which is leveraged also to the upside. So there's all kinds of things you could get yourself in trouble with.
Seriously. This is actually a good point here by Tom. There's almost too much information. It paralyzes me at times. That is 100% true and 100% why we have the coaching sessions.
Yeah.
Get clarity. Clarity is more important than the amount of information.
Yeah, anyone could watch YouTube videos, or you don't even need a book these days. You could just watch videos, you know what I mean? And like, I think someone mentioned earlier in the chat, Thinkorswim and most of the brokerage platform, they have tutorials. You could go to education on Thinkorswim and they give you plenty of videos to watch on. Even they talk about strategy. They try to get into a little bit of when to use it, when not to use it. But you really got to put the big picture together. And a lot of it has to do with what's the overall market doing, what sector should you be in, what stock, why are you picking this stock as opposed to the other 10,000 that are out there. That's the most important. Once you narrow that down and you actually have the name you want to trade, the strategy selection is probably one of the easier steps. You know what I mean? You just kind of look at volatility, you look at your time frame, and you make a decision as to what you want to do. But yeah, that's putting it all together basically is the challenge.
So on top of that, I believe is a big distinction as well, which is the distance between the entry and the result. Like we can have the greatest strategies in the world. We could have the best entries in the world. There's still the person in between making those discretionary decisions and producing a result, not necessarily understanding 100% where those results are coming from. So in other words, something that we've been working on a lot behind the scenes, because we spent a lot of time strategy, right? All that kind of stuff on strategy. You still have to implement it correctly. If you can put exactly the right trade on at the right time, you still have to actually follow it. And we have found, and especially doing one-on-one coaching calls here in the community, a lot of people know what to do, but when they're not getting the results they want, they don't know what's broken. Like they don't know like what part of their trading should they be spending time on. And most people default to, I need a new indicator. I need, like all those kinds of things. And
I need to read another book.
It's not the strategy that's broken. It's the implementation of the strategy. But a lot of people don't necessarily know what part of their trading is broken to get the results that they ultimately want. And I'm going to show something, John, that we myself, Joe, and Lynn have been implementing behind the scenes. And this is our diagnostics dashboard. And this actually, Joe actually is here. This is actually Joe's trades for the last 7 days. And it all really comes down to one of three things. How often are you winning? Is that a problem? How much are you losing when you're losing? And you want this to be as close to 1 as possible, meaning you're risking 1R and you're taking the 1R you promised yourself. And then there's how much are you making relative to the risk. So one of these three metrics are the place to dial in and say, okay, I'm not achieving what I want to. What part of my, we're calling it the performance engine, which is these three things, is broken. And the beauty of this is you just start to then focus on one thing. Instead of trying to fix everything at once, you're like, okay, my win-loss percentage is good. Maybe I'm not, and in this particular instance here, and again, this is day trading, so the numbers are probably a little bit skewed. Maybe I could earn a little bit more on my winners. Maybe I'd like to get it beyond 3-1 or 4-1. So now you start to pay attention to your profit maximizer or how you're managing winning trades. We're going to be introducing this to everybody pretty soon. I could tell there's a million things we're doing behind the scenes right now to improve the community. And we're building one for options as well. But this is really one of the things that, in my opinion, and this is from all the trades that I placed as well, having all the strategies in the world is awesome, but you still need to implement them properly. And we've been working very hard behind the scenes. And John, we're doing the same thing for you on the option side to get to a point where you can look at it and kind of say, okay, I know something's not right, but what do I fix? And that's what we're going to be working on soon with the community. And I'm pretty excited about that.
Wow. Wish I had that when I was 20 years ago, 30 years ago.
Me too.
Yeah.
Me too.
I had to use like
an John, come back and answer you about the options.
By the way,
you said he's probably talking about options on oil. He's saying you're correct.
Oh, futures. Yeah, definitely. Because you have to go. Futures are tricky because, you have roll risk. So, obviously you're constantly paying for the next month out and you have to do it a little bit more longer term, But yeah, options are great because they're a little bit more, especially probably with oil, they're a little more flexible. You get in and out of, But hedging is definitely more of an art than a science, I would say, because if you overhedge, then you're not going to make any money, right? If you try to make money both on your hedge and on your core holdings, then the purpose of hedging is no longer there, and then you're speculating. So the whole idea of a hedge is you're trying to manage risk that you already have. So understanding what the purpose of hedging is probably the most important thing.
It's also very
what is your purpose?
Taking a bearish bet.
Right. A bearish bet is you're just adding bearish exposure. That creates a little bit of a hedge in the sense that if let's say you're very long, you're very bullish, you have a bunch of longs in your portfolio, whether it be swing trades or whatever, and now things changed all of a sudden, and you don't necessarily want to reduce the number of trades you have because you like them. They're holding up okay. They're just not making you any money right now. Maybe they're flattish, but you want to kind of ride it out a little bit. Then you could, then just adding bearish exposure. That's just more balancing your portfolio. It's a little bit of a hedge, but it's really taking on bearish bets. You know what I mean? But a hedge is when you're actually looking to offset potential losses.
It's always the question we get is how much of my portfolio or the exposed part of my portfolio should I be allocating dollar amount to the hedge? And that's probably a whole other meeting we'll have, John.
That's $1 million question because how hedged do you want to be? Because if you, like I said, if you're 100% hedged, you might not make any money because you're over hedged. So 20% hedged, 50% hedged, that sounds like a pretty reasonable thing to be because you're still going to have losses in your portfolio if the market goes down. That's just the way, paper losses. But the hedge will kind of help cushion those blows a little bit. So, and there's different types of hedging. There's hedging like I said, there's hedging an investment portfolio versus hedging your trading book, which is a little bit different.
By the way, KG Oil, thank you for that comment at the end there. We
thank you. That. Again, didn't pay for it.
John's saying inverse ETFs don't trade as well as they did even last year. I've only been using them for very short-term moves. And quite honestly, I grew up trading short selling. The first 3 years that I traded, the market went down. It was a 3-year bear market after the boom. So I'm much more comfortable shorting than using an inverse ETF to be on the other side if the market goes down. But 95% of the market probably only likes buying, so they go up when the market goes down. So it's a good short-term play, I think.
Well, my question is, if you're trading an inverse ETF, first of all, do you understand how it works?
They have different expirations, that's for sure. That's why they trade weird.
Do you understand the mechanics behind how an ETF gets their leverage, or their inverse leverage, right? They do it in the futures market. And when you have volatility, for them to roll out into the future 2 or 3 times leverage of what they're trying to accomplish, they're going to spend a lot of money doing that to attain that 2 to 1, 3 to 1, whatever they're trying to do. And guess who pays for that? You, right? In the form of, because it's a fund, basically, it's a fund, right? So that gets put off into the fund, and so it doesn't always attain the 2 to 3 to 1 leverage it's looking to attain over time. In the short term, yes, it will attain 2 to 3 to 1 leverage on a day-to-day basis, but on a month-to-month, week-to-week, whatever, it does not. That's why people get very disappointed when they hold them for too long.
The timing of the hedge also matters too. Getting back to the hedging comment.
Yep.
Let's see. Thomas is saying one of the things I like the best about these calls is how unbiased both of you are. So many publications have a vested interest in certain stocks and can point people in the wrong direction. John, I think from the very first, thank you, Thomas. Obviously, we appreciate that. One of the things I think that clicked between us from the very first time we started talking is we actually care about if we're actually helping. And, you have to, we're very conscious of teaching you how to trade, not just the setups. And I think that's a big distinction.
Yeah. And that's definitely the first one, but also as far as stock selection, you know how many times I'll trade something, I have no idea what it is. And it's because I try not to have a bias. I try to do the exact opposite. You know what I mean? Because I find that if I have a bias on a particular stock, it could affect my decision making. You know what I mean? So I actually like when I'm trading something, I have no idea much about what the company does or what they're all about or what have you. You know what I mean? If it goes on my screener and it fits the criteria I'm looking for, I'm going to trade it, period. I don't care what the CEO had for breakfast this morning. I don't care what, is going on. I mean, fundamentals matter to some degree. If you have an edge, a fundamental edge, let's say their last couple of earnings seasons have been really good. If you could build a case for the stock on the fundamental side, all the better. You know what I mean? But that's not why I would necessarily get into a trade or not. So, I have a certain selection process when we go through everything, and that's all that matters to me.
Which we'll finish up with this question here because there's a lot to this question. So JD, we'll get to that in just a second. John, I want to ask you if you saw this article by Citrini Research.
Global intelligence crisis. No.
So I'll share this link to the article to everybody. And I actually created, I used Notebook LM to actually create a slide deck for it. I'll email this out to everybody when I email out the research for both of us this weekend.
They're trying to say
every place that I've been watching it, it's the article that everybody's talking about right now. And the funniest part, like right over here, is it was written on February 22nd, but they cross it out and say June 30th, 2028. And it's basically talking about everybody, and at this time in 2026, believing that AI is the greatest thing in the world, but it's basically 2 years going forward, everybody's out of a job and there's no purpose to life. But they tie it into the financial markets and whatnot. So I'll share this link with everybody, and I'll share the slide deck that I created. I'll put it in Discord and I'll email it out with her. It's worth reading. It's pretty fascinating.
Yeah, it's interesting times we're living in for sure. But I think that there is the risk of us getting a lot dumber if we're not careful. And I use AI to try to complement my ideas the best way I can. I'll ask it specific questions when I'm trying to arrive at a thesis, but there is the risk of using it to just do all your homework for you. You know what I mean? And that's, I'm afraid that the younger generation will start to do that. And that's,
they are already. I know a couple of people that are teachers, and some teachers love it, some teachers hate it.
Yeah. And it's, I find it really helpful. I had a issue last week where someone asked me advice on a very complicated structured note. The structured note involved leverage. It involved three different underlying assets. It was a super complicated note, right? And I took the term sheet and I put it in AI and I said, explain to me the pros and cons for this note in terms of, like, in layman terms, like you would talk to a 5-year-old. You know what I mean? And it gave me the answer that I was looking for, and it really helped because it helped me understand. But when you start to use it for, like, just giving people quick answers, that's bad news.
So let's tackle this one here. We'll finish up with multiple parts of this question. Can price, support, resistance, and volume be components of anchored VWAP? They're different. If you just take the context of what VWAP is, never mind anchored VWAP. VWAP is volume weighted average price, and that's, correct me if I'm phrasing this incorrectly, John, but it's basically where most of the volume actually traded, as opposed to a moving average is just price and kind of connecting the dots between closing prices. VWAP is actually a similar looking line, but it's where the majority of the volume traded. So a lot of people use it as support and resistance. Good traders use it as a direction for where the dominant bias is in that time frame and get a little more aggressive when there's separation from VWAP. And I'll pull up a chart just to show it. Actually, we could use the Costco chart that we talked about before.
So think of VWAP as like a volume adjusted, it's a volume adjusted average price. So it's where most people show up to the party, basically. That's how I like to describe it. And it gives you an idea of where institutions are willing to, most institutions want to smooth their orders out over the course of weeks and months. They don't want to stick their necks out if they're buying a large size. So what they'll essentially do is smooth out their orders over time. If a portfolio manager gets an order for 10 million shares to buy or sell, they're not going to try to dump it into the market and impact the price. They'll smooth it out. So when you see VWAP, when you see like a nice boring VWAP line, it shows you that there's some continuity, that people are buying and selling it in an orderly way. When you see that break that you mentioned, Pete, it's when people are starting to dump it or people are starting to buy it in excitement. And that could be retail activity. That could be an overbought or oversold condition. But it gives you an idea of what the institutions are thinking versus where the current price actually is.
Very different from just a moving average. So, for example, I'll put a 20-period moving average in here. The moving average is nothing more than the connecting the dots between the closing for that period of time. VWAP is actually telling you where money was spent and the direction of the money, which is why it's so powerful. I'm actually going to pull this up. This is the book that probably most people are leaning on for anchored VWAP, Brian Shannon. If anybody wants to pick up a book, it's really, really good. It came out, I think, maybe a year or two ago. But the difference between VWAP and anchored VWAP is they essentially work the same, but anchored VWAP is you can choose on the chart where you want to start measuring VWAP from. So, for example, I think Jane asked a question about this on a coaching call last week. You could anchor it to the day that they report earnings, and then you're looking at where money spent after earnings. You could anchor it to Monday's opening price. You could anchor it to the first of the month's opening price. So you're basically anchoring it to a significant reference point that matters to you. Again, we brought up before the weekly anchor trade. You could anchor it to Monday's opening price, and as long as it's above the anchor from Monday, there's buying in that particular week, which gives you a little bit more conviction to hold that trade. And we kind of talked also about, do you get out on Friday or do you hold it through the weekend? Well, if you're strongly above VWAP from Monday's opening price, buying pressure happened that entire week, and that might be a reason that you would consider to hang on to that trade through the weekend. So there's nuances to VWAP versus anchored VWAP. I always use it from the opening price in there. I know you could do multiple different ways of doing it, but whichever one you choose, pick the same one all the time. That's very important.
Yeah, anchored VWAP is also on the institutional side. It's used to measure performance. So, a trader, let's say they get their order to buy 10 million shares at 11 a.m. So to monitor their performance, they're not going to use VWAP over the day as their benchmark. They'll use anchored VWAP starting at 11 a.m. So on arrival price VWAP, which is basically anchored VWAP, they'll make sure that they don't, because, if something happens before they get the order, they can't control that, right? So it's not fair to monitor their performance based on what could have been. So they use anchored VWAP for that purpose as well.
Next part of the question here is, how do you define a trader's edge? For me, it's building a process for defining a likelihood. And the simpler way to put it is, do I believe that my profit target's going to get hit versus my stop loss? And you're building arguments, as we talk about in our game plan, which are essentially built of all the reasons you could possibly be looking to be a buyer of that particular stock versus all the reasons that you might not want to be a buyer. And we kind of frame this in what we call the power pyramid, which is essentially a way of stacking the reasons we'd want to be in the position. And obviously the technical context is the easiest because you're not looking at fundamentals and all those other kinds of things. And the way that John and I both do it, it's similar, just slightly different. Is, we start out with the market and we work our way all the way up to the individual stock. And we do something different than I think most people do, is we don't try and predict where it's going. Our systems are basically built around it's already going in that direction, and we have protocols to say, is it still valid versus did it end versus where is it going? We don't ask where is it going. We're saying, what is it doing now, and how do I know if it changed? And how do I know if it's still valid and to what degree, which would have us increasing into a position. So an edge to me is working towards building an argument for the likelihood of something continuing. And then, again, if we get back into this picture, we're adding, what is the market doing? What are the sectors or the individual sectors doing? What is the industry group doing? And we work our way up to building arguments for that particular idea. So I like to keep everything in trading so I could nod my head and say that makes sense. And if you really think about it, the only reason we choose to take risk is because we think something's likely to continue. And then the part of the trading is, how strong of an argument can we build for that continuing, which is what we do on our daily game plans. We're building an argument that leads all the way up to, and that means this many shares, or that means this much risk. So edge is really building the probabilities of something happening. And
what's the justification for this trade's existence? That's the short answer. You know what I mean? And as many bullet points as you could come up with, the more the merrier. You know what I mean? Whether it be technical, whether it be pyramid, top down, you know what I mean? Is the market good? The sector good? Is it in the right group? That kind of stuff. And then you drill down to the stock itself. It's above its moving average. It's outperforming its peers. It's got relative strength compared to its peers, compared to the market, compared to the sector. If you build all those arguments, and then, then there's the fundamental stuff too. Maybe there's a fundamental headline reason why that stock is better than its peers. That if you could find a reason. So you have all these reasons at the end of the day, and then that helps you build the argument for being in the trade in the first place. And then it also helps you manage the trade as you go along. So if any of those reasons get diminished in any way, then that gives you an alternative or a choice of an early exit, or to add, like you mentioned, if you get justified for those things, if they keep happening. So the edge kind of helps steer you along the management of the trade.